Okay, so hello everyone. We're here today in Zurich with a new episode of the Finance Association. Today we have Rémy Debucois. He's a Quant Engineer at UBS. So Rémy, can you start by introducing yourself, your background, and what do you do for people who are not familiar with quantitative finance?
Okay, so thanks for the introduction and for the invitation. I'm happy to have the occasion to speak about these topics. So I didn't start with a finance background, actually. I originally trained in physics, and I have a physics background. I did a PhD in Paris, and I moved to Zurich to do a postdoc. And the plan at the time was to pursue a career in academia as an assistant professor, and later professor. And during my postdoc, I realized that this isn't really what I wanted. Many reasons. First was from a personal perspective, that didn't align with my life goals, let's say. And second, the evolution of the job that would have been required as an assistant professor was not what I was after. I wanted to keep doing something, building something, and this is not directly what assistant professors do. I mean, they organize their lab, find students, have to teach. I mean, it's a lot more, and it's more administration and less hands-on. And this is not what I was after. And at the time, I didn't know anything about quantitative finance. I just thought about what I wanted to do, and I thought, I like programming, I like math. And this was, I'm not going to say a complete coincidence, because I did do my research, and I thought, okay, then there is this field which does hire people with a PhD in physics, and this is, I think, probably the second most common profile after financial studies. And I had my first position at a company called Swissquant, which sells risk management solutions mainly to banks in Switzerland. I mean, their business is much broader than this, but at least that was the primary business delivery that I was assigned to. And on the one hand, I found that I didn't know even what a vanilla option was, and so that was I learned on the job. But on the other hand, I also found that having skills in programming, in problem solving, and in mathematics were really useful, because this is what we were tasked with doing, not building software, and this is still a big part of my job. I'll get to that in a second. And having the ability to build that software with applied mathematics in it, not necessarily very complex models, but models that are robust and that will not blow up randomly if the data is slightly miscalibrated, for example. And being able to build something that is robust, that will stay. And in that sense, there is a continuity between what I was doing before. I was an experimental physicist, and I was building actually experiments, and I was working with lasers, with mirrors, with vacuum chambers. So there was a very concrete aspect, which I find to some extent still exists in software. Of course, you are writing outlines of codes, but you have to plan out what you're doing. You have to have some bigger picture in mind rather than quickly scripting something that will solve a very small, tiny item.
And how much do you think of your work is about refining strategies rather than building new ones from scratch?
I think I'm entirely not in that space. I mean, quant finance is, of course, about applying mathematical tools to markets, right? I mean, maybe people would disagree or refine the definition, as you recall. I don't have any formal background in this matter. This is how I would see it. And I was always involved first in risk management, meaning as, typical wealth management outfits, whatever you want to call them, are going to advise clients on the best asset allocation strategy. How do you do that? What's the best way? I mean, they will have their view on a given performance. I mean, they are going to be bullish or bearish on certain sectors, certain geographical regions. They are going to have some expert knowledge on time horizons and so on. But how do you translate that concretely? Right now, I assume that mostly everyone is going to be bearish on companies that import into the US. Then what? You've said that. This is maybe not a great insight. You can refine that perhaps by sector, by country of origin. And then what? How do you translate that into an actual asset allocation strategy? Given all the entire investment universe at your disposal, how do you build a portfolio for a client that's going to ask you, I want to take into account the constraints of the market right now, and I agree with the view that you may have, and I want to have some extra exposure to, I don't know, Swiss pharmaceuticals, and then what is the optimal asset allocation? How do you construct a portfolio? And of course, I mean, this is nothing new. The portfolio construction theory has been around for decades. But in practice, of course, you have stocks which are highly liquid. There it's clear, you can estimate, you can have some risk profile on them, you can see how they correlate with each other. The investment universe is huge. What if you want to have exposure to bonds, which may be less liquid? What if you're a Swiss investor and you want to hold one bond to the Zurich Zoo because with that you get a discount every year? How do you account for that in your strategy? That actually exists, even though I don't think this affects whatsoever the end performance of the portfolio. But I mean, it's this sort of constraints that you have to consider. What if you want to have some FX hedge in there? How are you going to do this? What if you want to have some funds, and how are you going to take the risk into account for a fund? I mean, you can see the past performance, and then what? How does this correlate with anything else you may have in your portfolio? I mean, some are simple ETFs, so that's fine. You can take the underlying as a proxy, but some have more complex strategies. Yeah, and this is the sort of thing. So in that sense, I mean, I think what you had in mind was how do I construct my alpha strategy, which I never did. I know this exists. This is completely outside of my field of expertise. But quant finance is not only about finding alpha. I mean, what I was describing is finding beta. What is the risk associated with a given asset, and how do you aggregate it over a portfolio? How do you compute it, and how do you get around data limitations? You can think about it. You can estimate future risk from past risk. This works actually quite well, at least for equities, bonds, funds. Rates, derivative, not so much, but I mean, rates are a more complex object. And
I have a question about the quantitative finance roles, but I'll keep it for later to finish with the first part. I would love to know, during your studies, doctorate, postdoctorate, what do you feel was the most useful thing that you learned that you're applying today?
I think this doesn't come from me. It comes from one of my colleagues who said that the main value of a PhD is being able to tolerate frustration. Because you spend a lot of time trying to figure out something, and this can apply beyond finance. You see, it's just you hit some problem which has a concrete cause, something not working in the lab, some model that you cannot really figure out, some piece of software that doesn't do what you want, some actual implementation that doesn't perform as well as it should, and that you're willing and able to say, okay, I will spend 10 minutes, an hour, 3 days, a month, a year to figure out what caused this. And of course, in the private sector, you don't have 1 year to figure out why some things are wrong. In the lab, maybe sometimes you do, and that did happen once. And it's being willing to say, okay, I have all this technical background, be it in programming, in mathematics, I have some financial knowledge. How do I apply this to this particular problem? And that you don't take, I don't know, for an answer. Maybe at some times you may have to, because you have other constraints that come on top, and the problem is only worth solving if it doesn't take you forever. But until then, being willing to continue and to figure out what is happening and to dig into it until you have a satisfactory answer. And I think this is the main skill that I did learn in academia that I'm still applying now. And of course, you can then have some sub-answers about having mathematical rigor, about knowing how to program, and this is a skill that you build up over time. But I think the main thing, the core thing is, in terms of problem solving, it's that you can solve pretty much anything if you have enough time.
So do you think maybe that doing a PhD was an advantage for being a quant today?
Yes. A PhD, I think, is an advantage. Postdoc, hard to say compared to a PhD. 5 years, probably too much.
Yeah, but, I can imagine.
But yeah, and when people think of problem solving as a skill, what they mean is that you don't give up when you have a problem. You actually solve it.
Yeah. Okay, so now my next question is about quantitative finance roles, which seem opaque right now. Like many sounds familiar, but they vary differently across other firms, and like it may be like the same title, but like it's completely two different things. And like now financial institutions like have engineering needs that are not very clear for everybody. So like for example, while like everyone assume that all quant traders are building alpha generating strategies, but like UBS and other institutions have diverse needs that are way beyond trading strategies. So I would love if you can tell me, like if you can clarify the key quant jobs proposed in financial institutions today.
Yes, I mean, if you think about it in the investment bank, so Credit Suisse or UBS, for example, they are selling structured products. This is where revenue, this is a part of the revenue generation, right? Because when you sell vanilla, simple thing, accumulators, yield enhancement products, capital protected notes, all you can think of, the gain, I mean, they don't sell this at par. There are some fees on top applied, and the clients are going to be clients who want to have their own risk management strategies. So pension funds, sovereign funds, every insurance companies, every big institution that would like to minimize their exposure to whichever risk. And so when they do that, what they've identified is a particular aspect of the market risk that they want to not be exposed to. And this is where they will go to any investment bank and ask for the best price for a given structured product. Right? And so in doing that, they transfer the risk from their books to the target bank. So I mean UBS in this example, and UBS is going to charge them a fee for this risk management. And because they aggregate a lot of risk, they can manage it more efficiently than any more fragmented institution can. So in that sense, the role of the trader is to say, I am the counterpart to whichever deal, and I have this on my books. I have to risk manage it during the lifetime. So for a vanilla option, that can mean I want to monitor whether I'm in or out the money and act accordingly. I want to apply whichever hedge to minimize my exposure. And because I will have many such options on my books with varied maturities, I can apply more effective risk management strategies. So they have to do the operations on a daily basis to manage this risk. But ultimately, if they do it well, they do derive a profit out of this. But even if they were just exactly matching the market, the bank would still make a profit just from the fees. In that sense, they're not looking for alpha. They apply strategies to make sure that they manage the risk that has been allocated to them properly. And in that sense, in this whole thing, there is of course the trader who maybe has a quant background, because the risk management framework has a heavy quant component in it. But there are also people in the background who are going to make the models that are used to price these derivatives, who are going to put together the data that is used in the models that price these derivatives, and who are going to put all the software chain in front that sits between the trader, the client, and the booking systems of the bank. There are three parts in this, and they all have to communicate with each other. This is a complex piece of software. It's not, and these are the roles that I've been at since joining Credit Suisse. And there, the quant knowledge comes from understanding quite deeply the structure of these products, for example, and understanding how you have to treat them, how you have to price them, in the sense that you're not making the pricing models, but the pricing models have hundreds of parameters that you may want to tune. How do you source them? What makes sense? How does this get aggregated together? And these are roles where you need to understand enough about finance, but you also need to be able to build decent software. So it's at the interface between the two, and this is something that I think comes back on a regular basis, that quants to some extent have to know how to program, and the quality of what they're being asked to deliver depends on the role they're in. In some cases, they may be looking for alpha, in which case they test out their strategies with scripts on their machines, and then they are going to apply them. But even if you say, I have some automated trading strategy that I want to put together, you probably don't want to rely on something that you wrote yourself without any external review or oversight. There are people who are going to have to look at this. It has to be tested. This has to be integrated in a bigger part to say, okay, this is how we are going to place our orders. This is how we are going to check that the strategy is working. Here are the safety measures that we put in place, and so on. So this is a multi-person job, and you cannot. Maybe there are some exceptions, but I don't think you can go away from the need of being able to program in some quantity. And
so, for you, programming is one of the skills that matter most in this.
Yes, I would say even beyond pure mathematical knowledge, because I think you can be a good quant even if you are not able to solve complex stochastic differential equations or to put them in a form that can be solved numerically. However, I don't think you can be a good quant if you don't recognize that you have to leverage all the tools at your disposal in the programming world. You don't have to know C++, for example. I mean, this is if you are going after performance, which is typically either because you care about the compute resources or you want to be extremely fast. You don't need to know intricate programming languages, but you do need to know that there is a bar that has to be met in programming quality. And this is something that you have to be aware of, and where the bar sits depends on the role. It's not going to be the same whether you're an analyst or a quant engineer in a given part of a bank, or whether you are right. I mean, is the software meant to be consumed by you, by the rest of your organization, by external clients? I mean, this is a complex question, but you need, I think this is a skill that cannot be neglected. And for most quant roles, if you say that you have limited notions of MATLAB and that you've never programmed and shared your code with someone else, I think that there is a difference in hacking something together because you want to solve a problem and making code that is meant to be reused and read by other people. If you have never taken this step before, this, I think, is a big red flag for anyone looking to hire you, for example. They want to know this person is going ultimately to produce code, and this code can be reused by other people. And the value, I mean, of course, you are around to work with what you produce, but your output is code and it should stand without you.
Yeah. And do you think maybe there is any other skill that should be a prerequisite other than coding for quant jobs?
I would say there it's hard to define, because this comes back to how do you work, right? And that would mean that you are willing to collaborate. But it means you can apply to anything. You are fine with working with others. You're going to play nice with them and not get defensive if you feel that they are trying to muscle in your territory or something. That you are not able to ask questions when you're stuck. I think this is one of the main things that I've seen with more junior colleagues, that when you recognize that you cannot make progress, I think it's fine to admit that you don't know something.
So to seek help.
And to seek help, and the question is, where do you put the limit? If you ask for help after 30 seconds, that's not so good. And we come back to this frustration, I mean, being able to tolerate frustration aspect that I was talking about before. 30 seconds is too short because you haven't made any real effort to understand. But on the other hand, if you spend a week by yourself trying to fix something that most likely someone could tell you the answer to in 5 minutes, you've also wasted your time. And it's a hard balance to find, but I saw way more people being on the wait for too long side than on the give up too quickly side. And this is also something that you have to learn, and this goes a bit against the way you work as a student. As a student, you're expected to find out the answers by yourself because you're in the learning process and you have to demonstrate that you know all that's expected of you. But when you take a role, you're not showing off how much you know. You're actually producing something, and it is fine to admit that you don't know and that you need some guidance, some inputs. And at any stage, I mean, I've now been 7 years in the field. There are things that I still don't know, and on a regular basis, I have to ask questions to the rest of my team, and I am slightly embarrassed to have to ask them what I assume are simple questions, but it's still better than assuming I know the answer and get it wrong.
To not end up in a good way.
Yes, exactly. So this is a skill, and this is not a skill that you can learn in advance, right? When it comes up, you have to recognize, maybe this time I should have spent a bit more time by myself looking at this, or this was way too long. I didn't derive any value from looking at this problem for too long. I should have asked for help earlier.
Okay. And like for students entering this job market, which roles they should prioritize?
I think that depends on where they want to go after. This is a pretty broad job market. I mean, you have everything from you have all the trading roles where you are going to have to come up with investment strategies. You have risk management roles, which are going to be geared towards the inside of your institution or towards external clients. You have all the wealth management ecosystem where you are going to have to devise strategies, but on a much longer time horizon, so the constraints are not the same. There are analyst roles as well, where based on the data you may want to derive some insights, and that's not necessarily the same as building alpha out of it. It's just how do you transform data in a way that creates indicators that may be useful to other people. And I think that depends on personal sensibilities, right? How much programming do you want to be exposed to or not? How much math do you want to be exposed to or not? And even how much, let's say, business-specific knowledge do you want to be exposed to or not? Because when you are building out a strategy, you can have some which are very generic, which consider abstract risks, or you can be closer to the macro side and rely on business analyst reports to help guide your decisions. I mean, it's not only a numbers game. There are also more real-world insights that may come in at some point, and that's also up to you how close you want to be to this. At the other end, it's how close you want to be to the end consumer of what you produce. Are you the end consumer when you work for a fund, or are you selling data to someone? Are you selling a product? Who is benefiting, and how close do you want to be to them? And I would say this is a too broad question to say what should one prioritize, because it really depends on what is the most interesting to you. And the second aspect, which is completely orthogonal and equally important, is how good of a feeling do you have with the company and the team that you would join as a junior in your first position. And it may be that you find the topic super exciting, but you work with people who don't have at all the same approach to work as the one you would like. And that can mean either they work 80 hours per week and you didn't want that, or the reverse. This is something that you want to be aligned on when you start, and you shouldn't. I mean, if your goal is to work 42 hours per week, this is fine, provided that your company is also fine with this. And their expectations have to be clear on both sides, which is maybe not so easy to clarify at the beginning. These are people that you are going to spend a significant fraction of your time with, so it's best if you get along to some extent with them. They don't have to be best friends, but if you cannot stand your colleagues, it's not great. So choosing the team matters, I think, at least as much as choosing the field in which you are, or the subfield of quantitative finance in which you choose to move. You also, to some extent, lesser extent, choose the company. Is the company going in a direction that I think is sensible? Not always easy to figure out.
But like quantitative finance is like very competitive. Like you have a lot of good profiles. So like, what in your opinion is the best way to stand out for students entering this job market?
So I think that there are 2 points to answer. First is before you land the job, how do you actually land one? And this is a bit harder for me to judge because I didn't go through that, and I'm a bit removed from this aspect now. But I would say first, having the skills and experience, maybe not that easy for the first job, to prove that you can do the tasks that are expected of you. I mean, I mentioned in most places you have to write code. Having some project, some internship where you actually did write code that was used by other people and people were happy, that's already a plus. I mean, having applicants come in and say that they've only done their higher education and learn Java or Python but never applied it anywhere, that's not great. So there needs to be some application of programming as a hard skill before. People are going to look at the grades that you were having, and of course, depending on where you come from, they are going to put the bar more or less high. But then it's also a matter of, unfortunately, having connections, and I don't want to say that in the negative sense, but trying to reach out to alumni from the previous year to have an idea what they do in their first role, and ideally to get introduced to other people in the same field, just to have some idea. Having some further knowledge of what you're entering into will make you stand out. Once you do get called for an interview, it's best if you can say, yeah, I've heard about what you do, and is this related to that? That you have some idea of what you're going into, and not just saying, I saw the job posting, and this sounded like something I would want to do, but what is it exactly that you do here?
Yeah.
Not easy either, right? Because in some places you don't have more to go on, and you cannot have a contact inside that tells you a bit what they work on. But overall, showing that you've considered why you're here and that you're not here by chance. And this is what they say for applications. You should not be able to send the same application twice to different jobs, because they should be tailored to the job that you're applying to. The same can be said for any interview that you may have. You should not be able to say the same thing twice to different people. If you start to say things which sound highly generic, then most likely you're not making a good case for yourself.
So research before.
Research before and reach out to people. And reaching out to people doesn't mean, do you have a job for me? I mean, that's usually not a great approach, but it's just, I'm interested in what you do. And this can be really people, alumni, so a few years older than you are, who are already in their first roles and who are happy to talk about what they do. And they just ask them, what do you do in your daily job? What's it like?
But the thing is that, like, in most of the cases, the alumni doesn't respond to...
Yeah, it's not... I mean, I know it's because I did go through the same when leaving academia. I reached out to many people. I saw you were a physics student before, a PhD, and can we chat about what you're doing now? And sometimes it works, sometimes it doesn't. This takes effort.
Yeah.
But in doing that, you do build out better knowledge of the industry that you are trying to break into, and that will show once you reach the interview stage.
Okay, so now we move to the next topic, which is machine learning in finance, which we've recently hearing a lot about it. First of all, I would love to hear what is your opinion about it? Like, what do you think about machine learning in finance?
So I think it's a topic that does hold a lot of promises. After all, you are told you can take any amount of data and some action comes out of it, right? It sounds promising. The thing is, for a lot of the financial field, we already have models for it. And the models are typically more performant than machine learning would be. I mean, if you apply, you can model movement of an asset with any stochastic differential equation. You can try to solve this. We have models that do quite well, and typically the reason we cannot always apply them is that because data quality is insufficient. You can use machine learning as a sort of predictive tool, and I would assume I know in the seeking alpha space, there are companies that do specialize in this, that they are going to use machine learning to identify patterns in historical data, and historical there can mean in the last 15 minutes or in the last day, and they are trying to identify patterns that they can exploit to generate alpha. This is something that works. I assume that for this to work, you need massive amounts of data and computing power. Do you generate alpha consistently, which is high enough like this? The fact that there are not a huge amount of firms doing this suggests that it's hard to derive value in this way. Because sure, I mean, your algo works, but you have to pay for the data, you have to pay for the compute infrastructure to calibrate your model, and you have to pay for the people who are going to put your model together. So the costs are going to be quite high. I think machine learning can be used to supplement missing data. And these are the applications that I did see and that I did use. For a lot of aspects, you are not going to have the full information about the assets that you're trying to price or to get to risk figures about. And from the partial information that you have, you may try to reconstruct what's missing.
But like financial markets have a very low signal to noise ratio, so extracting some signals without overfitting, like it's a very complex task. So how would you do to?
No, but that depends, right? For example, I mean, one of the cases I had was to give figures for liquidity risk for bonds. So you have, if you look at bonds, you can take the bid-ask spread and you can use this as a proxy for the liquidity risk. The larger the bid-ask spread, the larger the risk that even if you hold a bond which has a given present value, you will not be able to sell it for this value in the future because there are not enough buyers. And the tighter the bid-ask spread, the more likely you are to realize the value that you think you're holding. So it's not enough to say I hold a bond. Well, of course, if you hold it to maturity, that's not really the point. But if you plan to sell it during the lifetime, you care about this. You use a bond as a safer asset, and it has some returns which are linked to whichever. Well, you can implicitly say that it has a given interest rate on top of it, which maybe moves over time because the rating of the issuer changes or the market conditions change. I mean, this is one thing, and this is always going to be safer than an equity in a comparable sector. But then when you want to sell it, you do have to find someone willing to buy it from you at the price you think it's worth. And for that, you need to have a sort of liquidity indicator. And you would much rather hold bonds which are very liquid, because then you don't have this extra risk on top. When you have the regular market risk, you don't want to carry liquidity risk as well. Or take it the other way around. If you are willing to take on this extra liquidity risk, then you want to pay less. And you want to have a risk premium incorporated in your asset price. So you want to use the bid-ask spread, or you can use the bid-ask spread as a proxy for this risk. And for some bonds, you do have it. But for some bonds, you don't, because the data is not around, because there haven't been any trades in the past, let's say in the last 10 days, and so you don't think the figures are reliable, and so on. But you can still proxy this by saying, I can still infer a sort of liquidity risk, because after all, I know more about the bond than just historical prices of, buy and sell prices. I can look at who the issuer is, what sector they're exposed to, what's their rating, what's their country of origin, and so on. You can have all this extra data on top, and this matters. And this machine learning can do quite a good job at identifying liquidity risk as derived from the metadata, if you want, around a given financial instrument. You can have complex selection rules that are implemented by a machine learning algo because you maybe don't know how to do it yourself, or you don't know how to do it. And the case would be when you have a fund, and you are given access to the fund breakdown, so you know more or less what are the exposures inside in terms of economic sector or geographical region. In the asset allocation that we were discussing at the beginning, how do you then classify this? You have the full breakdown. What are you exposed to really in your risk universe, and how does this correlate with the rest of your assets? And you can, the approach that we used to have was to say we are going to see the exposure of this fund to any number of risk factors. But of course, if I take all the risk factors that correspond to what the fund has inside, you are going to overfit because the fund has a huge amount. So instead, you can have machine learning based selection rule that is going to narrow down the focus to just a few risk factors based on training data, because maybe some funds are more explicit than others in saying what they allocate to. Maybe you do have training data to build on, and this is the key, that you need to have correct training data, and then you can restrict the risk universe that you're exposed to, and you can have correct figures come out of this. And there, making a model for this is not so easy. If you had to do it without supervised learning approach, if you had to do it by hand and say, how am I going to assemble this? It's not so obvious what should take precedence. But instead, you build this sort of training data. And again, the goal is not that the model is correct. What does that mean? It is that you're going to be able to derive consistent predictions in terms of risk for these assets when they are put in a portfolio with other assets which may or may not be comparable. And this works. So it's a way, for example, to narrow down parameter space when you're going.
And like, how often do you refine this model?
So there, I mean, that depends on your investment horizon and how far back you look at risk. If you look at risk over the last half year, then I assume you would have to recalibrate this on the order of every half year. Probably more often, but certainly not every day. I mean, half year is 225 points of data. If you have a 10-year investment horizon, probably you do it once per year and you're fine because only 10% of your training data has changed. So that really depends on what you apply to. How I would say any model you retrain when your training data has changed appreciably. What that means is highly specific. So there, yeah. Of course, there are. Well, so yeah, that's the first aspect of the machine learning. The second is that usage of machine learning is also regulated. You cannot stick machine learning anywhere that you want in the quant world. For example, if you provide risk figures to clients, the model has to be validated in Switzerland by FINMA and by the financial authority in whichever other country you are based in. And they forbid from using machine learning because this cannot be explained. The model has to be validated and has to make sense and has to be supported by a proper mathematical description. You cannot just say, I have this black box and trust us it works as seen on backtesting. Also because I guess they cannot eliminate the risk that the model has been overfitting on some things, has been badly trained, has been fed wrong data. The model needs to be able to stand on its own, and having correct backtesting is is a necessary condition, but not a sufficient one.
And some people say that quantitative finance is about 80% of data, 10% of machine learning, and 10% of trading. Do you agree that data is the main topic when dealing with modeling?
Yes, that you need to have good quality data, and this. I'm not involved as closely as I used to be with models in my current role, but back at Swissquant, I was developing models, and there the data quality was the crucial thing. You can derive things that look nice on paper, and then you go and look at actual data, and based on actual data, you figure out how far you can take the models. And I was, for example, looking at a project around default risk. So if I buy a bond of any issuer, how likely is the issuer going to default in the coming year? And if I have a portfolio of bonds of all different issuers, I have market and I hold all the bonds to maturity, what is the likelihood that one of them defaults, two of them, and so on? And these defaults are correlated. And you can put together models, you can try to have a nice framework that describes this, and then you think, how granular can I be? How deep can I go? Can I have a prediction of correlated default worldwide? Can I have it by geographical region, by country, by issuer sector, by country and sector? And you can think of going pretty deep, right? And it turns out that because there are only more or less 2,000 default events worldwide in the past decade, you cannot go very deep because you cannot calibrate your model because data is what it is, and you can, at some point, you're going to overfit on something that's not really there because you only have so many events to look at. And this is a limitation of data, and the model that would have to be calibrated. You just cannot calibrate it because there are not enough such events for this to be meaningful. Having the correct quality of data is, I think, going to be essential for any pricing of derivatives as well. You have you have quantities which are all implied from the market that you have to back out carefully enough that you're not overfitting, that they are not discontinuous, that they are not going to induce jumps, that they are not sensitive to induce increases of the past few days, and so on. And there you need to have a good model and a good data handling procedure to say this data point I trust and this data point I don't.
But what are your tips and takes on the art of doing efficient and relevant data science in the financial industry?
This is so position specific that it's hard to
to have a very generic statement. It is that one should not underestimate the complexity involved with handling large amounts of data. Even from professional data resellers, there are going to be mistakes in the data just because they cannot. I mean, they have control procedures in place, but that's not always sufficient to figure it out. Data is going to be partial, things are going to be missing, and that means that whatever you build against this has to be robust to handle all of this. Do I throw away data which is corrupted? Do I try to clean it out? Can I detect data that's being corrupted because of missing or wrong information? These are all highly relevant questions, but they depend on the use case that you have.
So would you say the model is biased?
In some cases, yes. If you're not properly handling your data, you are going to introduce a bias in your model. You're going to calibrate it wrongly, and you're going to pay the price later. And that's also part of the job, ideally, of when you are doing it, to think about this and to avoid any bias that may come from anything that was present in the data that you hadn't realized or thought about when you first started.
Okay, so my next question is about alternative data like satellite imagery, web scraping, or credit card transactions. It's getting a lot of hype right now, but how much do large institutions like UBS rely on it?
So for UBS, I can't say because that's quite far from where I sit. So maybe they do, but I have no idea. But in general, it is clear that in addition to the highly structured data that you have from exchanges and brokers, there is a huge amount of unstructured data that is lying around, which in principle can be actioned. And the problem is there, extracting a signal from all this noise is probably even harder than from out of the market data. You have a lot of data, but you have not a real idea on how to process it. So there are a few examples. For example, satellite imaging, this can be used to supplement, at least by economists, to supplement missing GDP data for countries. Countries are going to report figures that may be wrong either because the countries themselves don't have enough information or misleading because they want to report more than actually happens. There was this idea that you can link the GDP of a country to the amount of light it emits at night, and which you can record by satellite imaging. And this happens to track GDP more accurately than other methods. Or you can try to count number of ships leaving a country, number of trucks leaving a factory, as a proxy for economic production. So there, in a sense, you would use this if you don't have more reliable data to look at. Either because it's not available or because it's private and you cannot access it. I don't know. I think you would try to apply the same logic in other places where you want to augment the data that you have rather than rely entirely on this. I don't think you would build risk management strategies or trading strategies solely on this alternative data. It is still useful, I think, in parts which are, I think, adjacent to the main, how do I price something, or how do I execute a trade. You can, for example, in all the ESG domain, so when I want to produce environmental, social and governance score for a given company, it relies on self-reporting to some extent, but I also want to have external figures for this. And there you can use this sort of extra data, not only the pure financial figures from the company, but looking at this sort of extra data to paint a fuller picture of what you're looking at. Same thing goes, for example, if you are trying to use sentiment data to try to predict in which direction the market moves. This is difficult because that means you would have to scrape a lot of data in real time and aggregate it to derive a sufficient indicator to be able to trade on this. To some extent, macro traders are doing that already. They are constantly consuming news analyst reports and the like to devise their strategies. Can you beat them? With an automated process, not clear. And again, even if you think that you could, somehow, after all, you have access to more or less the same information as they have, at least to the raw information. can you aggregate it together to derive a signal fast enough at a cost which is low enough for this to make sense? Because for all this alternative data, there is a cost to gathering it which is much higher than conventional data. Conventional data is reported by the exchanges, by the brokers. It has a price, but the barrier to having it fly around is not that high. For anything else, it has to be gathered, it has to be put in a format that is accessible. You are going to have to buy it, and then you are going to have to process it. Compute costs are not insignificant. When you have, especially if you are trying to crunch data in real time, on a daily basis or on an intraday basis, this is going to take quite a large budget.
And like if you're dealing with alternative data, do you mostly source externally from vendors, or do you build your proprietary pipelines?
At some point, I think you would build your proprietary pipelines, because vendors are going to break down the data in ways that they can resell to as many people as possible. And most likely your use case is unique, so you need to do the final steps. You can still, for sentiment, there are sentiment data vendors where you can provide a given company or a country or whatever and get a sentiment feed out of it. And then what? You still have to do something with it, and probably the sentiment feed that you derive is not precise enough, because you would want to extract the component of this sentiment that is specific to the financial aspect. And getting the sentiment, even now on Tesla, is maybe not a sufficient predictor to say whether you should buy, sell, or hold. You would need to have a more refined analysis, which means that you need to have access to the raw data to some extent, or the partially processed data. And then you come back to this data is expensive because someone has gathered it for you, and you have to process it, which is also likely to be expensive. Is the advantage that you derive out of this going to be worth the cost? And the fact that there are not, maybe that's because I don't know enough the field, but the fact that I don't think there are a huge amount of companies operating exactly like this suggests that it's hard. Maybe you can make it work, but it probably is hard to derive value out of this alternative data in a way that exceeds the effort that you put into getting a signal out of it.
And critically, how much edge does this data provide in trading strategies if you want to compare it to traditional market data?
I can't say, and that because I don't know. It's again, from what I have heard, having models that work. You identify some corner of the markets that where you think you can beat it, and you apply your strategies, and you make sure that this typically doesn't last forever, because at some point markets are going to catch up with you, and you constantly have to re-optimize or to find the new regime where this applies. And I have heard a lot more about pure quantitative strategies than using alternative data to find a place where you do beat the market. That doesn't mean it doesn't exist, but I would expect this is in the minority.
Okay. So I think we asked you all our questions. Our episode is coming to an end. Thank you so much for your participation. We really enjoyed it.
Yeah, likewise. Thank you for all the questions, and I hope I didn't confuse things further.